In this session on market efficiency, our focus is primarily understanding whether the markets are efficient or not, and what do we mean by efficiency itself. The most common meaning of efficiency that we discuss in this context is efficient processing of information. So, whenever we are talking of word market efficient, it's not transaction efficiency, right? It's not allocation efficiency. It's more from an information efficiency standpoint. Means whatever the information that is available, is it reflected? How quickly is it reflected in the prices? Right? So let's say a new news breaks up. How quickly is it incorporated into the share prices? Because any news, any data that comes out, different people process it differently. Probably you may think that that is a good news. I may think that it is a bad news. But some processing has happened, and based on the processing, people react immediately to that particular information. And that particular reactions will, if the market is very efficient, that particular reactions are happening immediately and they are getting reflected into the stock price very quickly, or for any market. It's not only stock market. See, when I say this particular, let's say I say the bond market is not efficient, which means whatever the political situation changes or economic situation changes, immediate buying and selling of the bonds, if it does not happen frequently and it does not reflect the prices immediately after the news is broken out, we are saying that those markets are not efficient for us. But stock markets, the moment a company releases its financial result, the markets immediately react to that number in terms of either a lot of buyings happening, lot of sellings happening. That information processing and reflecting in the share prices of the company is what we are talking about, the efficiency of the market. So here when this chapter of market efficiency is being looked at, we are more talking about the information efficiency. So that's where the statement is saying security prices, they reflect all the available information fully, quickly and rationally. Right? People think how this particular news is going to impact the performance of the company, and based on that they rationally think that the share price will either go up or go down. Right? It's not a gamble. They think a little bit in terms of whether this particular news is going to be good or bad. It's not a 50-50 toss. Of course, though some kind of decisions will be equally good, equally bad, but people have their own processing mechanism. And what we are saying is every information that is available, if it reflects fully, quickly and rationally, we say that the market is efficient. Again, that is even more a mechanism to say that no one can make unlimited undue profit in this kind of a market. Probably I'll give a much better example to compare with. When will I say a particular examination system is efficient? Probably let's say if people read the last 3-4 years question papers and they are able to confidently get 80-90% in the current year, right? Then I can simply say that the examination system is no way efficient. Because just by knowing some past information or just by doing some basic research work on the question papers and something, If a person is able to generate a success consistently, then it means he knows how to beat the system. He knows how to generate profit consistently. When see in some markets, okay, there you are passing, but it's not at the expense of someone else failing. Everyone is passing. But if we look at it the other way, that only 30% of the people pass, your gain is always at the other person's loss. The financial markets work like that only. One person's gain is the other person's loss. So now if you are able to make constant gains, consistent gain by some mechanism or the other, it means someone is losing consistently. And when someone is losing consistently, why will ever he come to the market? No one wants to invest in a market where he will lose every day, right? So which means the market is like a system. Okay, some person who is very good at finance, probably he may, or who is very good at understanding the behavior of the market, probably in 70%, 75%, 80% of the cases he should be able to make abnormal profit. But at least 20% of the cases he may not make the profit, because system is much bigger than an individual. No one can make undue abnormal kind of profit consistently, because different info, not a single person cannot process all the information that is coming in, right? So the understanding the complexity of the system is not that easy, which means a person who knows some mechanisms of valuations and blah 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 stuff, he should be able to make profit, but not that consistently. He is only making profit better than others, but it's not that he will make the profits every time. If he is able to make a profit every time abnormally, then it means he knows how to beat the system. And if someone knows how to beat the system, then probably there is a possibility that the system will become more and more inefficient. Like if one person knows how to leak the question paper consistently, he can make the system fully inefficient. Probably it will not stop only with him. He will try to create the Xerox copies of those question papers. He will try to create a kind of a mafia gang internally, who will be responsible for selling the leaked question papers for a huge price, make money out of it. He can make undue profit, and that makes the system more and more inefficient. So we have to really know, see, any investment that any person is willing to make in a market, he will generally invest in that market which he finds is more and more efficient, right? I don't want to put my money in that particular market which can be manipulated very easily, where some person knows how to manipulate the numbers and create a profit for himself, right? In those kind of markets, I don't want to put my money at all, right? Probably sometimes we say, right, in case of lottery, I don't want to buy a lottery ticket, because sometimes or probably these shops and showrooms, they announce so many bumper draws. We have a very common feeling in our mind which will say anyhow they will give that bumper prize of a car to some of their relatives only. So when we know that that is the scenario, that lottery system process is becoming inefficient, though they may be doing it on a very impartial basis, but majority of the people have that kind of a thought process, that that particular bumper prize is given to someone internally itself. So they may have to adapt to some other process to make sure to ensure the people that that process is very efficient. So they may bring a big celebrity to do the to identify who is the winner of it. So they do various other things to ensure to the people that what they are doing is more genuine, and it's not an inefficient kind of a process. Similarly, when we talk about the stock markets or any market, any information that is available, the person should be able to process the information, and he should be able to invest accordingly, and sometimes make a profit, sometimes may not be able to make a profit because someone else might have reacted already immediately to that, or majority of the people reacted in a different way and I have reacted in a different way. So all these things could very well be different from person to person. So that is where what we are saying is only unexpected information should elicit a response from the traders. Otherwise, should have already got reflected into the price. When see if you are expecting the company will grow at 10% every year, if it has grown at 10% only, no big change should come to the price of the company. But if it has grown at 25% when they have released the result, or they have grown at minus 5%, because people all of them have thought that it will grow at 10%, and based on that they might have processed that information, they might have purchased the shares accordingly. But if the reality is 25 or minus 5, which is much away from their expectations, then that unexpected information elicits some kind of quick reactions from the traders at that point in time. So what we are saying is if a market is fully efficient, even active investment strategy will not give any positive return. Like, which means mutual funds is of no use. Portfolio management is of no use. If the markets are fully efficient, all these things will not work at all. So don't use your own fund management. You follow the index passive strategy. Because at some points in time, we see that the markets are inefficient because not everyone will process the information in the same way, right? So sometimes, even if everyone has processed the information, you may process it in a completely different way and find a gap. And those are the ones where people are trying to make a profit, right? Probably everyone is thinking that the market will move like this, but you have thought that the market will move like this based on whatever the processing which you have done. So you want to take an advantage of this, right? But not every time this kind of strategy will give you extraordinary profit. So that's where what we are saying is in some cases it will give you a profit. In some cases it may not give you a profit because you are taking a risk in terms of thinking differently from the regular, right? Only those kind of strategies can yield some kind of a profit in some form or the other. Now here, that is where we always talk about the difference between a market value versus an intrinsic. Market value is the share price. Whereas when I talk about the intrinsic value, or probably the better example is, let's say we talk about a TV that is available in the market, right? A particular brand of TV, blah, 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 blah. Now the market price of that TV is fixed. Someone has decided it. Let's say two of you are going to the same shop to buy a TV. One of you may think that the TV is worth the price. The other person may think that the TV is very high priced. I'm not bringing the purchasing power of the person here, right? Let's say the TV's market price is 50,000. Both of you are comfortable in terms of spending 50,000 for a TV. So I'm not bringing the affordability angle there. But still one of you may say, no, this is very high price. Whereas the other person may say, this is aptly priced. I'm ready to buy it. Because the way the information is processed by both the people is different. The person, one may feel, why should I be, for this kind of sound quality, for this kind of blah, 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 whatever are the features, I think 40,000 is sufficient, 50,000 is more. I don't know what mechanism he has used, but he has done some kind of valuation for that. What mechanism he has used? He might have used a sophisticated mechanism, or he must have used a intuitive kind of a mechanism, whatever it is. But this is a very common statement we make, right? So from there only we start our bargaining process. We don't know on what basis we'll come out with that number, but we have a number in mind. Whereas the other person may say, oh, these are the so many features that are there. I don't mind paying 10,000 extra for a brand. So I'm ready to pay 50,000 for this. So what is coming out here is the market price is the same, but the value which each person is perceiving about that particular product based on the information that is available to him. Probably if you have asked the shopkeeper, he must have given both of you the same brochure about that product. So the data that is available to both of you is still the same. But based on your past experiences or based on how you process that information, the decision which you are taking in terms of the value that you are associating with that product is different. Right? Probably the villagers are even more comfortable with these kind of valuation process. Even an uneducated and illiterate person also can decide what dowry his son should get. Probably with X education, he should get some this many lakhs, a better education, some more lakhs. On what basis that is getting decided? Even that's a product that is getting sold. Right? So on what basis? That is also a valuation. So what mechanism you are using to value is a different thing. But the market price is the price which probably a girl's parent is paying for it. Each girl's parent, probably for a guy, he might decide I should get these many lakhs. Probably a girl X rejects him, a girl Y will accept him. Though the price is the same, the person is the same, assuming the affordability of the girl is also the same. So at what price she should purchase this particular product, she can decide, or her parents can decide. And how this pricing is coming, each one have their own processing mechanism. So any product, any stock, any security, every person has his or her own mechanism to evaluate. So the very common evaluation mechanisms you will see as a part of the valuation processes, whether we call it as free cash flow based valuation, some technical names, or some people call it technical analysis, some people call various other names to it. But how you process the information is purely as per your capacity. But you are arriving at what is called as intrinsic value, and based on this intrinsic value, we are deciding, we are comparing the market price. We are comparing the market value with the intrinsic value. If the market value is cheaper than what we are perceiving, we are ready to purchase that. If the market value is more than what we are perceiving, we don't want to buy that. That's a typical valuation process. What mechanism you use for valuation, you can decide. For stocks, we may use one method. For bonds, we may use some other method, like that. So the intrinsic value is the price that the investors, with full knowledge of the assets characteristics, we have seen the brochure of the TV completely. With whatever the knowledge we have about that particular brochure, about that particular TV, we are giving one value to that TV. The market price is what is said by the company. The value, intrinsic value, is what the buyer is perceiving about it, based on the processing of information. If you are not able to process it, you will take the help of your friend. He is like a financial analyst in a financial investments case. You will take the opinion of a friend whom you think knows more about the TVs. Here also you are approaching a financial analyst whom a person thinks he can process the information much more efficiently than an irrational kind of an investor. So someone is deciding the intrinsic value for that, and based on that, the buying and selling process occurs. When do we say market efficiency? What is observed is if there are more number of market participants, the market efficiency will be very high because there will be a good number of buyers, good number of sellers, right? Some people may say it will go up, some people may say it will go down. So buying, selling will happen to the fullest in that kind of market, right? So if there are large number of participants, you could very well see, and the information is freely available, probably media or through various sources, the information is very freely available. We see that in those kind of markets, there is a very active liquidity or active trading that is happening, which will lead to great efficiency in the market. But if the short selling is not allowed, because in most of the markets, short selling is sell without owning, buy it in the future and pay it back to the broker. In most of the markets, there will be a lot of restrictions with respect to short selling. Only some kind of stocks can be shorted. Not all stocks can be shorted. Or probably in some cases, trading costs are very, very high. Right? So let's say probably a stock is available for 200 rupees on BSC and 197 rupees on NSC. Probably a person could have immediately thought of, why not sell here, buy here immediately and make a 3 rupees profit, multiply it with probably 1 lakh shares, make a 3 lakhs profit. But will he be allowed to short these many shares here? Right? Is that much of availability there? Are there any restrictions? What is the brokerage cost in this entire transaction? Right? We did not add the brokerage cost. If I add the brokerage cost, probably this gap is no more existing. If the brokerage cost for buying here, selling here, right? If it is one and a half rupee here and another 2 rupees there, so my total brokerage costs are 3.5 rupees, and there is no point in exploiting this kind of difference. This will keep the markets more and more inefficient because people can't exploit these kind of differences. They keep the differences as they are. Keeping the differences as they are is again resulting in some level of inefficiencies coming into the market. So people who can plan out their game very well, they will try to exploit them to a certain extent and remove the inefficiencies as a part of the market. So sometimes the inefficiencies will persist because of all these kind of scenarios, whereas in some cases they are exploited very easily. So whenever we talk about the efficiency, we are talking of 3 levels of efficiency. So typically we call it as the weakest form, semi-strong form, and the strongest form. What the weakest form says is, all the past price and volume information, historical prices and volumes, they are reflected into the security price already. Which means a person, just by doing past price and volume analysis. What is that means? Past price and volume analysis, we call it as technical analysis. If a person is doing a technical analysis and making profits, abnormal profits consistently, only, like some statistical analysis on the past price and past volume, if he is doing some kind of graphical or statistical, some kind of analysis only on that price data, and he is able to make abnormal profits consistently, then we say that the market is inefficient even in its weakest form. Even in its basic form, the market is inefficient because the person, just by doing some mathematics on the data without knowing even finance, just by doing some kind of number game on the data, he is able to make consistent profit abnormally. Then we say that the market is inefficient even in its weakest form. So which means, if I have to say the market is efficient in its weakest form, a person who is doing technical analysis should not be able to make abnormal profit consistently. He can make a normal profit, that too some number of times, but he cannot make abnormal profit consistently. If he is able to do that, then we are saying that the market is inefficient even in its weakest form. Then comes the semi-strong form. All the publicly available information is reflected into the stock price. What is the publicly available information? Probably the financial statements, any news about the company. They are all publicly available information. The website of the company, whatever is given on the website of the company, that entire thing is a publicly available information. Now what we are saying is, any person who is able to make consistent abnormal profits just by doing some kind of analysis on the financial statements of the company, or probably the data or the information that is available about the company on the website, if he is able to make consistent abnormal profits, then the market is inefficient in the semi-strong form. Which means, who are those kind of persons who typically do the analysis on the financial statements, fundamental analysis, or financial analyst? Whenever I say a financial analyst, his primary role is doing some kind of analysis on the financial statements, or even the website, the news and all about the particular company. But that information, as I said, different people will process it differently. Now, if one person is able to make abnormal profit by that, then it means if all people are able to make abnormal profits because of that, then the market is inefficient even in its semi-strong form also. So, which means fundamental analysis should not give abnormal profits consistently. Right? It should give profits. It should give, a person who is a good fundamental analyst, probably he should be able to make profits 80%, 85%, 90% of the cases, but not 100% of the cases. That too abnormally. Even a big financial analyst or even a big investors like Warren Buffett or probably Rakesh Jhunjhunwala have made huge losses on various investments which they might have done. Even though they are very good at all these kind of analysis, they might not have consistently made abnormal profits in all the scenarios. The third is the strongest form, which is more like insider information, not a publicly available, privately available information. Right? Just by knowing privately available information, which is probably insider kind of information about a company, if someone is able to make consistent profits every time, then the market is inefficient in the strongest form. Probably the thing what we see is, the market might be very well efficient in the weakest as well as semi-strong form, but may not be that efficient in the strong form, because there is a good possibility that people knowing the insider information may make consistent profits abnormally, because they know what kind of project is going to come up and what kind of impact that particular project may have on the company. If that information is revealed, there is a good chance that that person can typically make a huge profit, and that is one of the prime reasons the regulators intervene there and say insider trading. They put so many norms with respect to insider trading. And also probably our uh, our very own ISB chairman, Mr. Rajat Gupta, was sent to jail just because of the leaking of the insider information itself, because that's more from a regulatory standpoint. Any insider information, if it is leaked to make a profit, because the market may not be efficient in that form, the regulators intervene to make the market efficient in that particular form. But if we are talking about technical analysis and fundamental analysis, what is technical analysis? People use charts, publicly available information, right? Even if they are using financial statements, the data that is available is same for everyone. Now, how you process it, not every time you can process it correctly. Probably, as we have seen in FRA also, probably most of there could be a good number of financial statements which could have been manipulated. One single person cannot keep correcting all the information. It's not literally possible, which means the profits cannot be fully consistent. Abnormal profits cannot be fully consistent in those kind of efficient market. But in a strong form efficiency, as an insider, if I know what are the kind of projects I'm going to crack and what kind of impact each of the projects are going to have, obviously I can make very well abnormal profits consistently. And that is where the players like regulators will intervene in terms of stopping those kind of insider trades, putting some kind of limitations on those insider trading activities. So this I think we have discussed to a large extent. If the markets are weak form efficient, technical analysis does not consistently result in abnormal profits. We have already discussed this statement. If the markets are semi-strong form efficient, fundamental analysis does not consistently result in abnormal profits. Fundamental analysis is necessary if market prices are to be semi-strong form efficient, because different people will process it according to probably a similar kind of a formula, but with different assumptions. Right? When we are doing fundamental analysis, we are doing a financial statement analysis itself. What you may analyze as a financial statement analysis, you may think that yeah, the company has improved. Whereas someone else looking at it, they may say the company has not improved, because there is nothing called good or bad. Right? It's more about on a comparative note. Depending on what you are using for comparison purpose, you may feel that this is better than this company, this is not better than this company. Right? If the markets are strong form efficient, active investment strategies does not result in profits. Because now, if they are, probably someone may think, oh, Maruti is going to grow like anything, because there is some information about the Maruti's investment strategies next year. Right? So active investment strategy is what I'm putting lot of my shares in Maruti. I'm buying lot of shares of Maruti. So if it is strong form efficient, no active investment strategy will typically work, because how you assess the private income, probably you may interact with some people. Based on some interactions, you may find that this is more better for investment. Even that is reflected. So even if the markets are strong form efficient, portfolio managers can add a value by establishing portfolio risk versus return objectives. Diversification strategies they may bring out to make some kind of a profit by reducing the risk and keeping. We have seen that by creating a portfolio, the return would be compromised a little bit, but the risk would come down drastically, because one single company is not what is being looked at there. In a portfolio, see, when I'm talking of one single company investment, probably strong form, efficient, inefficient, all will come out. But when I'm creating a portfolio, I'm outside the scope of one single company, comparing how these two companies will fare, and based on that I'm creating my strategy, which is purely based on the correlations between the two securities and all these things also coming into picture. Sometimes we have various anomalies. Anomaly is something like the efficiency is getting violated there. We keep the we keep the anomaly as it is. We let the inefficiency, as the earlier example I was talking of 200, 197. I don't exploit that. I don't typically exploit that mispricing. I'll let the mispricing continue in the market because it may result in extra costs for me. Trading costs are higher, or sometimes the information itself is very costly, right? So to get that extra information and then process, my cost could still be higher. So those are what we are calling as market anomalies, wherein we are talking about a deviation from the efficient market hypothesis. So what we are saying, they are not violations, but because of okay, the general thing is, let's say there could be some kind of calendar anomalies, like, or better simple example to start off with is overreaction anomalies. What do we say in this case? See, when a news is announced, sometimes market reacts very fast in terms of increase in the price or decrease in the price. There is a very quick reaction, like it has happened in case of Infosys. When they have released their result, on one single day there was a sudden fall of 22% in the stock price of Infosys. A sudden reaction. But the reality may not be to the extent of, the Infosys did not perform as badly as it has to be fallen by 22%. Overreaction by the market. But what happens? There is a slow correction mechanism. Correction may not happen. The next day itself, it does not get corrected by 22% up. The reaction is slightly slower. So overreaction sometimes and correction takes a small, so which means during that period, the anomaly is persisting. And typically in US, we find this effect called January effect. What it says is, see, generally that is the time for tax filing. What they typically do is, let's say a company is making some profit. It has to pay tax on the profit. What they'll do is, during the end of the year, they try to sell off all their loss-making securities. Look at it. They try to sell off all their loss-making securities. Let's say you have invested, or let's say an individual, my company. As an individual, I have to file my tax return. Based on my salary, I have to pay this much of a tax. Or I have to file my returns for tax. Now what I am saying, as of 31st December, I might be holding some shares in the market, but some of them may be loss making. Some of those shares may be loss making. So what I'll do, I'll sell off all those shares at a loss, which will reduce my tax here. Because if I'm making a loss here, right, whatever the tax I have to pay, that will get reduced. So the share price of that, because a lot of people do that kind of selling, especially they try to sell off those small companies' shares which are loss making, right? So the share price of those small companies actually go down very drastically because everyone wants to sell off those kind of shares to save their tax. And immediately in January, they will buy back those shares at a cheaper price. The same shares, they are buying it at a cheaper price because again that will, now the share price has gone so low, they can very well buy it at a much cheaper price. So for those small companies, what people have observed is the share price goes down towards the end of December and it again picks up in January. Right? Until so, irrespective of the performance of that company, the share price is falling and rising. Those are the various anomalies that could get created in the market because of various reasons. So all those anomalies are more like they are deviations from the efficient market hypothesis. If the market is very efficient, that particular share, that particular company share should not have fallen, because the information about that particular company should reflect in the stock price. Whereas here we are not talking, the price is falling and growing not because of the performance of the company at all, but because of some other external events that are coming into picture. People's tax saving pattern, or probably overreaction to some news, slow corrections, and probably momentum based anomalies also could be there, like a particular company which is generating profits. Generally it is observed that people suggest, yeah, in this company I have made a good profit. It may so result in the next period also it can go into a profit. Price moving in trend. Sometimes people will, generally if the price has gone up, people will try to sell off them. But in some cases what could happen, short-term profits will again follow with the short-term profits, will again follow with the short-term profits. Those are the various scenarios where you can see various anomalies that are getting created. Or sometimes we hear these kind of statements. Long-term underperformance of IPOs. We know from historical IPOs, sometimes we say IPOs at the time of issue, they are issued at a much lesser price. In India, that's a very common talk which we go with. Because the investment bank wants to be slightly safe off, they will try to underprice the most heavily traded, the most popular companies IPO, they always try to put it at a much lesser price or slightly lesser price, so that they are much safer off in terms of disposing all the shares to the public. So, and over a long run, there is a possibility that those IPOs may or may not perform also. So what we are seeing is, the simple logic which we have to understand from this is, there are so many anomalies where the efficient market hypothesis may not hold true. Efficient market hypothesis is what? Some information about that particular company will immediately reflect in the price. So if at all I am using the efficient market hypothesis, those small company shares, I should exploit them in December. January effect example. When I know that the share price of the companies will go down in December, I could have easily exploited, but no one will buy the shares in December because they have some other problem. Getting it? They have some other problem, so they will not buy the shares in December, even though they know that they are underpriced. Even though they know that their price has fallen drastically, no one wants to buy it in December because of the tax. They will buy again in January. So which means for those 3-4 days, that mispricing is still allowed in the market. So those are what we are calling as anomalies. So that is where we have to differentiate between a behavioral finance versus a traditional finance. Traditional finance is all about numbers, whereas behavioral finance is all about psychology. Right? You have to understand the psychology of the investors, how rationally they are behaving in various scenarios, because it's more about the perception of the customers, perception of the investors, rather than the financial performance. So that's where today behavioral finance is growing as a much bigger world as a part of investing, along with the traditional financing world. So more of a psychology of the investors, under which kind of scenarios. Otherwise, what is the 22% drop? Did Infosys generate such a big loss that its share price has to fall by 22% in one single day? Right? It is more of a reaction which the various investors or which various traders do to that in terms of processing of the information. So that's where behavioral finance talks about the rational as well as irrational investors, and the kind of reactions they do, the way they react to the various situations or various information that is available to them. So it's always better, apart from understanding various financial models and mechanisms, it's equally good to understand the behavioral side of the investors also, so that you can place your trades accordingly, right?